In the mid to late 90s, when day trading was coming into prominence, firms like E-Trade and Schwab were kind of the first companies to introduce day trading. They didn't have the technology to do proper pre-trade vetting on every transaction. In order to protect both themselves and their customers, FINRA came up with a rule to require accounts to have $25,000 essentially minimum balance in their accounts, or they were limited to a certain number of trades. Essentially, this was done because at the time the firms didn't have a way to monitor these real-time balances, so people were depositing $1,000 and trading essentially unlimited trades, and it was putting obviously firms and clients in a tremendous amount of risk by allowing that to occur.
What have been the most significant impacts?
The main impact, which was intended, was to limit the amount of trades that accounts with less than $25,000 could do. The unintended impact was that as we've seen a number of new firms come on board for trading, customers who are actively trading may fall below that $25,000 threshold. And because of that, they can no longer trade. So what they wind up doing is they close an account at one place, open an account somewhere else, and they start trading again. So it creates a lot of movement around individuals bouncing firm to firm in order to be able to continue trading because of the limitation that was put in place, 25 years ago. Because we have proper pre-trade vetting at this point, we can determine at the time of trade the amount of margin requirement, the amount of risk an account is taking on. We no longer have to limit the number of trades. If an account with $5,000 can trade as much as they like, because we know that we can validate their buying power prior to the transaction being entered into the system. There's really no reason to do this anymore because of the technology advances we've had.
Did you see growth of retail traders in futures because of this rule?
There is no pattern day trading rule on the future side. So there was no limitation there. And, you're giving somebody essentially 6-to-1 leverage on a futures product with the margin requirement without having to have that restriction. Same way essentially on short sale rules as well. One of the reasons that we're starting to see some movement from the equities world is that I think they see that the futures world is a competitor to them, and they want to make sure they don't lose more market share to the futures world. There are products that are coming out on the future side, tokenization on the digital side, smaller products on the future side to appeal directly to retail customers. Coinbase futures, those are really retail specific type products on the future side. I think the equity world sees that as a threat to its market share.
What role has fractionalization of shares played on this?
It's allowed smaller participants to actively trade more expensive names, but lowering the notional quantities. But I think that's not as important. I think where you see fractional really trading now is where it's migrated to is, it's notional trading where people are, I want to day trade with $500 and I don't care what my share amount is. When we first saw fractionals come out, we saw a lot of sub one share transactions. I think that's become less and less. I think what we see now is a lot of, and TradeStation doesn't do fractionals, but just speaking as the industry, I think what we're seeing now is a lot of round lots plus fractional where you're just getting type of notional type trade. Somebody wants to buy $500 worth of Tesla. It's trading at, $260. So they buy 1.9 Tesla or something like that. It's just a easier way to trade versus trying to trade to a round lot number.
If regulators got rid of the rule, what would that mean for traders?
I think you'll see less movement between brokerage firms. Somebody will find a firm they're happy at, and they'll be able to stay there indefinitely and not be forced to move because of running into a day trading restriction. You're going to see accounts with less money, say a $10,000 account, be able to be more active in the markets and potentially, a larger participants in market share. I think over time, we'll probably see the continued increase in retail participation. Right now, there is essentially that limit of 25,000 that is a barrier to entry for active day traders. I think we're by reducing that down, we're giving a larger group of clients a chance to become active traders and participate in our capital markets the way they'd want to, not by the restrictions that we're imposing on them.
How could a more democratized approach to market access reshape trading strategies?
We're putting a restriction on customers from even managing their own risk. When you talk about option trading, a lot of option trading is about risk management, and in some ways, we've limited the amount of risk management that clients can do on their own account. Sophisticated traders who want to properly manage risk and properly manage their accounts are somewhat handcuffed by the day trading rules. And I think that by removing them, we're allowing people to properly manage their accounts the way you want sophisticated traders to do. I think there's going to always be people who think, well, this is just going to let people go crazy trading. I don't think that's what I think of it. I think it's going to allow people to trade their portfolios in a way that they want to without having an arbitrary $25,000 number set in front of them, which doesn't really apply much anymore to the type of risk we're dealing with retail traders.
What is TradeStation's plan with this change?
We plan on having this ready to go on day one when the rule is approved and adopted. For our clients, we think we have a superior trading platform and product that allows our traders to trade the way they want, but far too many of them have run into the pattern day trading restrictions and have left because that we were not permitted to allow them to continue trading. It creates attrition where people don't want to leave, but they're forced to if they want to continue to transact in their accounts. It forces retail firms to compete on service and product and technology versus just, hey, people came here because they had to leave their old firm. I think we see an opportunity to, we think we have a high-end technology product. We think we have a extremely competitive front-end platform. We think we have execution quality, which is as good as anybody on the street. But we don't want people to leave here because they, fell below $25,000 in their account. I think this helps us maintain competitiveness and, lets us compete on equal footing with everybody across the retail ecosystem. I think this is a long overdue change for the markets and in the equity markets, the equity option markets, and hopefully the FINRA and the SEC approve this quickly, and we can start seeing the benefits. Start seeing retail traders can start seeing the benefits of this.